Point one, markets. Markets have had a fairly quiet week in the run-up to Easter holidays, but we have to remember that we have had 6 positive weeks in markets since the low in February. The S&P 500 is 4.5% from its highs. Investor sentiment is much more comfortable now, as are our portfolios, and volatility levels are half of what they were in February. Point two, Brexit. It's been quite noticeable that the UK equity market has lagged in the latter parts of the rally. We put this down to the uncertainty surrounding Brexit and the EU referendum that is coming up in June. Now, we know that the bookmakers' odds are 60 to 70% probability that the UK will remain within the European Union. Our portfolios are positioned accordingly. If, as we have noted previously, there is any volatility in the short term, we will take advantage of those opportunities that arise, but we do think that in the long term, the UK economy is robust enough to be able to weather the event. Point three, an economic update on inflation. One of the key messages in economics this week is that we've seen US core inflation, which excludes food and energy, print at 2.3% year on year, which is the highest rate that we've seen since early 2012. Now, this has been fairly broad-based. The market is discounting less than one rate hike in the US for 2016, so disinflation has become a deeply consensus view. If these inflation trends follow through, it will be supportive of bank equity themes, as well as things like US corporate loans, both of which we hold in our portfolios.